We're here to discuss the Silicon Valley real estate market analytically. This will help you decide what's the best time to buy if you have flexibility when you're buying or selling, and just gives you an overview of what the market's doing, not only globally, but in 20 local micro markets. And here's a summary chart of my micro markets. These are 20 micro markets in Silicon Valley. We start off with Santa Clara County, then we hit San Mateo County, and finally we hit Alameda County. The first two are sort of your active inventory and your offers. Those are sort of the keys, but they don't tell you what the market's doing because it's the ratio between the amount of active inventory and the offers. But the highlighted yellows are your leading market indicators. So you can see this area here is doing well, which is Cupertino and Sunnyvale. It's got a hot marketplace. You come down here in these areas here, the San Mateo County coast is all blue, so that would be a slow marketplace. And then you have overbidding, which is, the lagging indicator telling you where the market was. Frequency of overbidding telling you where the market was. Appreciation just telling you where it's been the best investment since 2015. But unfortunately, this doesn't tell you where the better investments are going to be. But basically what it does tell you is San Mateo County got hit pretty hard. And basically that was where the job centers. Buyers used to pay a premium to be close to work. They're paying a lower premium now, which gave those areas less appreciation. And, they're still respectable appreciation. They're basically at, numbers right around 50%. Since 2015, that's basically some number around 5% a year, not worried about compounding. And if you bought a property with 20% down, you get 5 times that. So you're actually made 25% on the money you actually put into the property. Santa Clara County, the heart of it, is almost 100%, some number around 90%. And Alameda County is more spread, with Berkeley and Oakland being down at 50% and areas like Union City being at 110%, which I think is the highest rate of appreciation, which would be Union City and Newark and Alameda County. And then finally on the price, I follow the median, the middle number, but I also sandwich it with the cheapest 10 percentile and the most expensive 10 percentile in an area. So the price range you're going to see in a given area. Now, yes, you can get a house more expensive or less expensive, but it's only going to be less than 1 in 10 houses are more or less expensive. And then a rough estimate of the payments there for those that are concerned. So here's your active inventory. You can see a little bit of lack of inventory in Alameda and Santa Clara County. San Mateo County is basically at normal on both sides of normal. On to offers accepted. Here you can clearly see the blue over all of Silicon Valley showing a lack of inventory. The one exception is the Palo Alto, Los Altos area, the Menlo Park, Portola Valley, which is basically exactly at normal. And there's an area down here that's normal too, which would be probably Santa Teresa, Blossom Valley, and it's barely normal. It's 86%. These two areas are right at 100%, and the only areas that are close to 100%. So they're getting the normal number of transactions. Here's your days of unsold inventory. You can see the bulk of Silicon Valley is typical, where you'd expect it to be compared to normal. You can see that San Mateo County is slower, especially along the coast. The areas away from the hub, the city hubs, the populated area, and also the South County area of Santa Clara County is slower than normal. That would be a slower than normal market pace. Here's your days of unsold inventory raw count. So this is just my estimate of where the market should be. So even though the market is normal, it's a fast-paced marketplace. And welcome to Silicon Valley. There's a shortage of housing, so the marketplace is always aggressive out there. So you have a fast-paced market, even though that's slower than normal. Here's the time for 75% of the sellers to sell. And you can see all these areas here. There's less than 3 weeks for 3/4 of your sellers to sell. The only area taking longer than 3 weeks is the coast, which was really blue, and it's only at 2 months. You go to most areas of the country and they'd be happy selling 3/4 of their homes in 2 months. It's just that would be slow for Silicon Valley. Here's ask price reductions. You can see the San Mateo County coast is doing 4% price reductions, followed by Redwood City at 1.7, Oakland at 2.5. But you can see that the bulk of the area is more or less taking typical price reductions, which is basically 1/4 to 1% price reductions. Here's the frequency of price reductions. Very rare for sellers to take price reductions. They're doing their research. They're putting their home on the market at the market price. They're selling within a couple weeks. They don't even have time to do price reductions. So you can look at these numbers. For the most part, they're in the low teens, and the highest number is the San Mateo County coast, where half the sellers are doing price reductions. Oakland's a third. But other than that, you're basically in the lower part of the teens, and there's a fair number of single digits. Milpitas, North Valley, Berryessa, Santa Teresa, Blossom Valley. This is overbidding. This is the magnitude of the average overbid from the buyers when comparing the buyer's offer price to the seller's ask price. These are the percentage above the seller's ask price. So you can see the vast majority are below 10%. The bulk of them are actually below 8%. The exceptions are Berkeley and the city of Alameda at 15% and Oakland at 9%. This is the frequency of overbidding. So how common is overbidding? The only place where overbidding is not common is the San Mateo County coast, where only 1 in 5 sellers gets more than their asking price. Everywhere else, it's somewhere closer to 70 to 80% for the most part. This is the appreciation since the last 9 months, and you can really see the concentration of low appreciation in San Mateo County, the high appreciation sort of in the outlying affordable areas, whether it be Alameda County or Milpitas, Berryessa, or Santa Teresa. And this is directly related to the pandemic, in my opinion, and the fact that people are not as willing to pay as a high premium to be close to work, and they're willing to pay, which causes them to go further out, driving up the prices of the further out marketplace. Here's your sold price. And again, I have the 10 percentile, the cheapest you'd expect in the South County is at $900,000. The typical home is at $1.3 million, and the most expensive you'd expect to find is about $2.3 million. So you have a complete range in each of the 20 micro market areas. Here, red is simply the areas that are more expensive. Still in San Mateo County and Santa Clara County, right on the border, are the expensive areas. The more affordable areas are the more outlying areas in Alameda County and within Santa Clara County. Here's the first summary slide. This is for all of Silicon Valley, which is going to be Santa Clara County, San Mateo County, and Alameda counties in a blender all together. And what you have is basically 4 lines on every segment. The purple line is the current data. The fine gray line is where you expect the market to be based on the past 10-year median for the metric. The red line is where you'd expect it to be in a seller's hot marketplace. And the blue line is where you'd expect it to be in an ice cold buyer's marketplace. So you can see we started off with inventory lower than expected because the purple line is below the gray line. And now we have a little bit of a bigger gap. We started off the quarter with 91% of the inventory you'd expect, and now we only have 80% of the inventory. The lack of the inventory is half the story. The other half of the story is come down here and look at offers accepted. We started off the quarter at 77% of the number of offers you'd expect, which is why you're below the blue line. It's rare that you're that little offers accepted. You can see that we basically, I guess that's about 11 weeks ago, traced the blue line, and now we're ever so slightly above the blue line, and we're at 81% of the offers accepted. So we've gained a little bit of the number of offers. At the same time, we've lost inventory. What's that mean? That means the days of unsold inventory, the speed of the market's slowed down. It went from 36 days to 43 days. It's taking longer to sell properties now in general. And this is a theoretical number. It's how long would it take the market to go? And it's slowed down as far as the absolute speed, but it's accelerated as far as the speed compared to normal. Because back here, you're at 119% of normal. With days of unsold inventory, the larger the number, the slower the market, the longer it takes to sell everything. So you were 20% more time to sell, and now you're actually 1% less time than normal to sell. So on a percent of normal, we've improved, but yet our absolute time has slowed down from 36 days to 43 days, basically a week longer. Then for those that are confused by data in general, this is a pretty simple data point. It's simply how long does it take 3 out of 4 sellers to sell? So 3 out of 4 sellers sell in 14 days at the beginning of the quarter. Now they're taking 24 days to sell. At the beginning of the quarter, it was 82% of where you typically are. So you were on the red side of the gray line. Now you can see that, basically 7 weeks ago or something, we caught up and we were right on the gray line. And for basically the last 7 weeks, the time for the sellers to sell has been exactly normal, basically right on top of the gray line. Now you can see it's 2% above. 2% is nothing, when you're talking swings of 20%. So I would call that absolutely normal as far as the speed of the marketplace. But for ask price reductions, these are the price reductions that sellers are taking in order to get their offer. Back at the beginning of the quarter, they were taking a 0.5% price reduction. And believe it or not, that was actually 50% greater than they normally do. In rough numbers on the fly, they were taking something like a 0.3% price reduction, and now they're taking 0.5 of a price reduction. That's roughly 50% larger. But now in the current time frame, they're actually taking 1.1% price reduction on average, which is actually now only 31% greater than normal. The big reason for that is the blue line's fallen away, so there's more of a range from the gray line to the blue line. And all the first 5 indicators we've gone over are all leading indicators. So things that tell you what the market, is a hot or cold marketplace. Now, inventory and offers accepted by themselves don't tell you what the market's doing. But there's a strong correlation. If there's a lack of inventory, you have a seller's marketplace. But conversely, if there's a lack of offers, you have a strong buyer's marketplace. In this case, the ratio of the lack of them is both right at 80% for all intents and purposes, which gives you an absolutely normal marketplace, which is your indicator. So we're having basically an absolutely typical Silicon Valley marketplace. And you can see that in Days Unsold Inventory, the time to sell, even the price reductions. It may seem like a 33% price reduction is more than normal, is big, but these are such tight metrics. It basically says that sellers are getting tired and being a little more aggressive in their price reductions. And then also the overbids now is a lagging indicator because you have to wait for escrows to close, and it's exactly at normal. So we're basically having an absolutely typical normal marketplace, just with a lack of volume. Now we're looking at something a little different. We're looking at days on the market. So this is how long it's taking to sell the properties. So 10% of the sellers are selling the property over here in a time frame of somewhere less than 5 days. 25% of the sellers are selling somewhere right, and we're currently on the purple line, somewhere around 7.5 days. 50% of the sellers are selling somewhere right around 10 days. 75% of the sellers are selling, and that's my sort of benchmark, up here somewhere around 27 days. And then 90% of the sellers are sold right about here, which would be just about 52 days, it looks like. But the main purpose here is to look at the difference from last year. This blue dotted dash line is where we're going to start off, which was a year ago, August 16th, 2023. We're looking at data now from August 16th, 2024. I use a real estate fiscal year that starts on March the 1st and moves forward a week at a time. Then when I get around to February 21st of a year, I don't jump forward just 7 days, because that would put me on February 28th, and I wouldn't be back on my fiscal year. I jump forward 8 days to March 1st. And on leap years, I jump forward 9 days. So you're comparing the same dates year after year after year to get rid of the shift that you otherwise would have. And the purple dotted dashed line is the current data. And you can see that it's taking sellers longer to sell this year than it did exactly a year ago. But what we're going to do is we're going to start off a year ago, and then we're going to jump it roughly a month at a time. It'd be 5 weeks, and that'd be 4 weeks, and 4 weeks, and 4 weeks, and then 5 weeks. You jump of either 4 or 5 weeks at a time until we get back to 3 months ago, which is 13 weeks ago. Then we flip over and look at the last 12 weeks and recent data on a weekly basis. And the first set of data is dotted. The next oldest data is dashed. And then the most recent data is solid lines. So you can see you're bouncing right around. You're going there. You're slowing down. So this is the end of 2023. And now you're into 2024. There's the peak of 2024. And now you're starting to slow down. And you can see you're just slowly marching up. There you go. Solid lines now. July 19th to 26th. And now to the current data. This is basically saying that the market's slower than we were a year ago, but we're still a relatively fast marketplace, because basically 75% of the sellers are selling in less than a month. basically, if you come out here, it's something like 78% of the sellers are selling in 1 month or less. Now we're doing the same thing with price reductions. So in this case, the blue dotted line up here a year ago is higher than the purple current line. So that's again says that the market's cooler right now than it was a year ago. But we start off a year ago on August 16th of 2023, and we step through. You can see the big price reductions. So now we're into 2024 bouncing a little bit, and now you jump. That's a huge jump. And now there's the peak of the marketplace coming back down. So we've been slowing down since basically April 19th, April 26th was the peak of the marketplace this year. Here you can still see you're marching down. Now you're starting to get a little bit of a bounce as you went up, but basically the trajectory is still downward. You had several weeks there together. Now we're going to have a couple weeks together here, because this week is better than last week through here. From up here, it's exactly the same. So basically, sellers are taking, and what would you expect? You'd expect more and more sellers to do price reductions, because that's what happened last year. You didn't expect the dotted lines here to be your future predictor, because this is where the market was a year ago, and you can see that we were below a year ago mark. So you'd expect that trend to continue going forward, barring some other influence. Now we're looking at the buyers overbidding, and this is how when they go in and they write their offer, how much over ask price. Here you can see the purple line is below the blue line, and that's towards the cool. So again, the market this year is cooler than the market was again last year. And we start off a year ago, and there you can see we're slowing down for the end of the year. That's the absolute bottom of the marketplace. Now you're into 2024, huge run-ups in the spring. You see the big jumps, and now you're taking smaller jumps on the cool downside because you had a plateau. And one of the things I observed was the overbidding is closer to the peak of the marketplace than one would expect. And I think the rationale for that is a buyer that's overbidding a lot is going to try to make their offer as attractive as possible, and that would be a quick close. So instead of taking 4 to 6 weeks to close, they're taking 1 to 3 weeks to close those way high overbids. That reduces the timeline to get to the peak overbidding. So there's still a lag time, but the lag time varies. And as you go from a hot marketplace to a slow marketplace, the time lag expands back to the 6 weeks. So it's 6 weeks, typically 4 to 6 weeks, because there's a range. And then as you get to the peak of the marketplace, that shortens down to 1 to 3 weeks, because the buyers that are being aggressive in their overbid are being aggressive in their closing. And then it expands back out to the 4 to 6 weeks. Here is the long-term numbers. We go back all the way to 2014, so you can start seeing, and there shouldn't be a cycle on here. You should be absolutely normal. So when you have big perturbations off of this normal line, something went wrong. And the biggest one right here, the spike, is COVID, when we couldn't even show property when we started doing the shelter in place. Well, inventory is the purple line, and you can see that right after we could start showing properties, inventory became really scarce. The DUI became really scarce, but the number of offers shot way up. And that's why inventory became so limited. It wasn't there was a lack of sellers. There was everybody's housing needs changed with this vertical spike. And so everybody that could purchase something that was more fitting to their new needs. And then it wasn't until partway through 2022 that we started having a lack of offers. And then you can see it came down, and we've been basically almost a year and a half, maybe even longer. Actually, you could probably call it 2 full years of this low level of offers, down somewhere around 75% of the offers you'd expect. So we've just lost 25% of the market, and we didn't gain 25% of the market for 2 years. You may have gained 15% of the market for 2 years, but that'd be being generous, and this was being fairly accurate with 2 years of 25% of the market. Now, you might notice on January 1st, 2023, I changed the horizontal scale. So the vertical lines here are years, and the thinner lines are your quarters. So this is a year before 2023, and then afterwards, this is a year. And I do this so that you can have one full cycle on most of my graphs that are cyclic in nature. And as I said, this one is not. And then you can see the current changes. So currently, you can see the speed of the market, the gray line, which is probably the most important, is exactly normal. But you can see that your inventory in the purple and your offers in the orange right around 80% of them where they typically are. Basically, as I've been saying in many different ways, you have a low number of transactions. So now let's dive into it. Here is looking at the inventory. On these graphs, again, you have the separate scale starting on January 1st, 2023, where it's expanded out. And here you have an annual cycle. And that's what my color lines are now. The gray line is where you'd expect the inventory to be. The red line is where you'd expect it to be in a hot marketplace. And the blue is in a cold marketplace. And you'll see when we get to offers on the next slide, the red and the blue are flipped because a lot of offers is a hot market and very few offers is a cold marketplace. So you basically can see that we've been tracing the lack of inventory since January 1st of 2023, basically, lack of inventory. And now it's starting in second quarter, we gained inventory. And that's where we went from that 70%, 75% up to 80%. And now we're basically fluctuating. You'll notice that this spike here, this is July 4th, and it was a little bit bigger this year, the impact than you would expect. And I believe that was because July 4th was on a Thursday. People want to be wherever they're going for the 4th. So they were traveling on the Wednesday. So a fair number of people took Monday and Tuesday off and made it a bigger than typical holiday. Every holiday negatively impacts real estate except for Mother's Day and Valentine's Day. Here is now looking at that same information. And here's where we pulled out the gray line, the typical line where you'd expect it to be, and are just looking at the changes. So you can see that we've been below the number of offers basically since January 1st of 2023. Yeah, you started off at normal, and then you plummeted down at the beginning of second quarter. You were all the way down to like 65%. But, this is where we've been bouncing around some number, whether you want to call it 75%, which would be right on this faint horizontal line, or some other number, but 75% is a pretty good sort of average of where we've been. You're seeing just the lack of inventory. Again, the faint vertical lines are your quarters, your dark vertical lines are your annual years, your January 1st. And on January 1st, 2023, I changed the horizontal cycle. So now you're looking at offers accepted, the same concept. Now, as I said here, the lack of offers is blue, and you can see we've had basically a lack of offers since right about here, which is basically the start of third quarter of 2022. That's 2 full years, and we're starting our third fiscal year of low level of offers. And, that's resulting in layoffs in the title industry, the lending industry, the termite inspections. You can see how rapidly it changed, and this is the 2022 meltdown, and this would be April 1st, and you can just see how rapidly it came down. And, that was probably the most drastic, the biggest, and the shortest duration in how quickly it went down reduction I have seen in my career. And again, you can come back here and pick up COVID. The market was going nicely. We hit the shelter in place, it went down. We could start showing houses. And again, look how rapidly that went up. It basically caught up to where it would have been plus more. And then in 2021, it was even the peak of the marketplace. Here's the same concept. You pull out the gray line and you can see that we've been down somewhere around 70%, maybe a little bit more because you have bounces on both sides. This graph looks like I'd be being generous at 75%. Here's days unsold inventory. And here, because we're lacking inventory and offers, we basically have had a normal marketplace since sometime early in first quarter of 2023. So we've had a year and a half of an absolute normal marketplace. Yes, there's been some fluctuations. You were a little bit faster through this section right here because the purple line is below and the red is below. Then you got back on, and now most recently, we're a little bit above the gray line, which is a cool marketplace. It's taking longer to sell. Here's the same concept. So you can see, basically since actually a little bit below end of first quarter, beginning of second quarter, about halfway through first quarter of 2023, we were more or less normal. You dipped down in the hotter marketplace, came back up, went down, came back up. We're cool and normal. And now in the last couple of weeks, we've improved and we're getting back to an absolute normal marketplace. And you can see there is a fair amount of fluctuation in this particular metric. You can see hot marketplaces are down in areas like this, which is basically third and fourth quarter of 2020, all of 2021, and first quarter of 2022. Here's the speed of the marketplace for those that like an easy to understand number. You can see that in 2023, houses were selling rapidly, and they were selling rapidly now. Where the real change occurred is right at the beginning of third quarter, where we went, we were basically touching the red line, having the market as fast as you'd expect it to be. And now we rapidly got up to the normal, and we've been right on normal, and we're a little bit above normal right now, but that was because normal normally goes down a little bit there. So here's again the same graph. If it was a normal line, you'd be right on this horizontal line. You can see we were cooler than normal, then we were hotter than normal, and right now we're basically normal. And you can see the rapid change right here that corresponds with the rapid change on the previous slide right at the end of second quarter, beginning of third quarter. That was basically the July 4th week. Now, because price reductions are such a tight metric, I'm ignoring 90% of all transactions and just looking at the 10% of the sellers that are taking the biggest price reductions. And you can see that where they should be is up here. They're down here, which is still above a real cool marketplace. But you can see that sellers have been doing normal to greater than normal price reductions ever since basically halfway through second quarter of 2022. And in 2023, they were taking bigger than ever expected price reductions. And then they came back up in between the two for the bulk of the time. So it just gives you a feel of what's happening over time. Here's the stretch. Here on this graph, instead of having the normal line at 100%, it's typical for the sellers that are taking the largest price reductions to be taking price reductions even in a hot marketplace. So we have a little bit of an offset here, and that's why normal is not at 100%. It's just my guess. I think I drew it at about 94, 93%, maybe probably drew it at 92.5%. And so anything with less than a 7.5% price reduction would be down here, and anything more than a 7.5% price reduction would be up here. So here's where you're taking larger than normal price reductions, and you can see on this graph more clearly. You come back to halfway through second quarter of 2022, and this whole time, sellers have been taking larger than normal price reductions. You can see the impact of COVID back here on 2021 right here, this little spike. After, with the run-up in market, sellers were taking typical to a little bit less than normal price reductions. And then we had this huge spike in 2022 just before the crash. And then look how rapidly and how sustained that increase in price reductions were as sellers got used to the market went away. Here is the average price reduction. So this is what more people would look at. And I don't know that many people that look at seller price reductions, but you can see this is sort of your average seller. And again, you can see that the red line rarely never gets above 100%. It did basically very short periods of time for spikes. And that's basically because of this little period in 2022 and this little period of time back here in 2018 that pulled up those numbers, since I go and use the data for the 10 years. But you can see that you've been taking average, because you're right on the gray line, or larger than average price reductions ever since we crossed over way back here in 2022. So you come up to the top. And the reason I have the axis on the top on this graph is as you go down here, these are greater and greater price reductions. So the point of the greatest price reductions was back here on January 1st of 2023. This is the average seller. So the average seller is taking about a 1.1% price reduction. And that's not what happens. It's typically some number around 10, 15% of the sellers taking somewhere around a 10% price reduction. And that's even an over exaggeration, because there's going to be some sellers that are taking a much larger price reduction. But that's the drawback of an average. But an average is going to be a lot more meaningful than a median, because a median price reduction is going to be zero, because we're only talking about somewhere around 7 to 25% of the sellers taking price reductions. The median is a 50% point, and that would be zero almost all the time in Silicon Valley. Here's the graph now with the average pulled out. So you can see the average line, but the window of normal is down here below. So I would consider it to be an average marketplace if we're in that white area. And I might have to expand it a little bit, because now when you start going back here, it comes down to more like a 1% price reduction. And this is a fairly new introduction, and I'll probably make that change at some time. Here's the frequency of price reductions. So instead of, we had been looking at the magnitude of price reductions, now we're looking at the frequency of price reductions. This is how common are price reductions. And basically price reductions are exactly where you'd expect them to be as far as frequency. So that's indicating that the sellers that are doing price reductions are doing larger price reductions than normal, not that a larger percentage of normal sellers are doing price reductions. That was the case with a larger number of sellers doing price reductions through this period of time here. So basically from third and fourth quarter of 2022 and first quarter of 2023, more sellers than normal were taking price reductions. But basically since halfway through 2020, second quarter of 2023 to now, it's been basically typical number of sellers. You might say there was less than normal here, but that was, a pretty small number, and I have to go back and look and try to figure out what caused that perturbation. And here's the same graph with the gray line pulled out straight. So you can see up here you were taking greater price reductions, greater frequency, but basically for the last year, we've been basically taking normal frequency of price reductions. Here's the average overbid. So this is what buyers are doing when they're to get their offer accepted. And you can see the buyers are still coming in with more than typical overbids. We're getting very close to typical overbids the last couple of weeks, but historically in the last year, buyers have still been overbidding the seller's asking price. So buyers are feeling a competitive marketplace, even though there's a lack of transactions. And here's the same concept with the gray line pulled out normal. So you can see more overbidding than normal up through here for about the last year. But right now we're on normal. I don't know if we're going to turn around and go back up again. There's no way to know what the future will do compared to normal. You can start making models of what is likely to happen based on what typically happens. But when you're comparing typical, you would expect it to be right on this gray line is what you'd expect. Here's the frequency for the last 10 years of overbidding. So now we did the same thing. We looked at the magnitude. Now we're looking at the frequency. So the frequency of buyer overbidding is basically absolutely normal. It's just a little bit more magnitude. Your change on the x-axis is here on January 1st, 2023. But at this point, the bold lines are quarters, not years. And that's what was throwing me. But again, you can see absolutely normal frequency of overbidding. Here is long-term pricing. You can see that the slope blue line is sort of the rate of appreciation you expect. We have this thing that happens every year in Silicon Valley where you have a run up, basically second quarter in pricing, run up in second quarter, run up in second quarter. But you also more prevalent have this dip down at the end of every year. And that's exactly what we did. Dip down, run up during second quarter, roll over and come back down. I would expect this dip to sort of continue to go down until the end of the year. Anything can happen, but it looks like we're going through a significant price reduction in Silicon Valley. We were all the way up here for a median of 1750, and we're now down to something approaching 1550, which is more than a 10% drop already since the peak of the marketplace. And again, this is going to be for Santa Clara County, San Mateo County, and Alameda County. And it's on log paper. And the advantage of log paper is the straight line is your rate of appreciation. Here's estimated payments using the average interest rate for the nation and then what the current payments are. It assumes an 80% loan. So a person purchasing the most expensive 90% home in Silicon Valley would have a monthly mortgage payment of about $24,500. Now, it would be very rare for someone buying the most expensive home to be putting down only 20%. And it might even be hard to find a lender to do that, but I kept the formula the same for comparison purposes. Here's where the typical payment is down here at, call it $11,750 basically for the typical home in Silicon Valley. And these are single family homes. It's about $6,500. And these are rough estimates. I'm using estimates for property tax, estimates for insurance, and estimates for mortgages, assuming a 30-year fixed at the national rate average. And jumbo rates are lower. I haven't looked at it recently, but Wells Fargo was locally on jumbo money was about 0.5% below the federal national rate. So these are going to all be on the high side because I'm using an easy to locate interest rate that I have the track record for back to 1971. Here's looking at just the active inventory. Now what we're doing is we're looking at the 3 counties. You have Alameda County in the gray, which has the most inventory, Santa Clara in the blue, and San Mateo in the orange. I would actually say just looking at this, San Mateo looks like it's the closest county to normal, probably followed by Alameda and followed by Santa Clara. That's just guesses looking at the graphs. Offers, Santa Clara County and Alameda County are very close together. And Santa Clara County is higher but had less inventory. So Santa Clara County is going to have a faster paced marketplace than Alameda County. And offers accepted in San Mateo County are below. So they're going to be slower than they typically are. And their San Mateo County is typically the fastest. And that's what you have. Santa Clara County is the fastest marketplace here, is measured on days unsold inventory. It's somewhere around 35 days. San Mateo County is at 40. And if you come back historically, you can see that San Mateo County is typically faster than the blue pre-pandemic. Post-pandemic, it's been slower than the blue. So San Mateo County went from the fastest marketplace to the second fastest with the pandemic. And Alameda County has sort of always been the slowest and is still the slowest marketplace. But keep in mind, we're going to see something pretty interesting coming up where, so I'm saying Alameda County is the slowest time on the marketplace with about 47 days to sell their inventory. Time on the marketplace is the same order. Alameda County is the slowest, San Mateo County is the second, and Santa Clara County is the fastest. That's the order you'd expect. Now, if you look at price reductions, Santa Clara has the least amount of price reductions. Santa Clara, San Mateo, and Alameda County are right on top of one another, which is consistent with the previous data. Here's the frequency. Alameda County has the most price reductions, which is consistent with having the longest marketing times. San Mateo County is in second in the orange, and San Mateo and Santa Clara County is the fastest in the blue, all consistent with their marketing time. Now look at this. This is overbidding. Alameda County, that had the slowest marketing time, the longest marketing time, and the longest days of unsold inventory, has the most overbidding. It's at 7% overbidding. Santa Clara County, that had the fastest marketing time, has the lowest amount of overbidding at barely just over 4%, and San Mateo is in between. So the buyer's overbidding is not in logical order based on the time on the marketplace, based on price reductions, based on everything. Now, maybe what you can argue is Alameda County is taking the most price reductions, and that brings in overbidding because the buyers are now bidding on the reduced price, and that would be the potential. But so few sellers take their price reductions, I wouldn't expect that. So it's just an anomaly to have the overbidding not to be in sync with the time on marketplace. Here's the frequency of overbidding. Alameda County has the most frequent overbidding. Santa Clara County is second, and San Mateo County is third. What you'd expect is Alameda County to be the third with the longest marketing time, giving more sellers time to reduce their price. It's not the way it is. Long-term appreciation, Santa Clara County is doing the best of appreciation, down around somewhere around 87% since the last 3 quarters of 2015. Alameda County is in second place. It's somewhere right around 70%, and San Mateo County has the least appreciation, and that's somewhere around 65%. You can see before the pandemic, they were all doing very similarly, and the pandemic started to separate them, and now we have a little bit of a spread. Here's your pricing. I put in the horizontal line just to come back. All 3 counties are now below the pricing they were in 2022. Alameda and San Mateo County are basically at the pricing they were back in 2021. Santa Clara County is still above. But look how all 3 counties are coming down in price. And we're not talking about insignificant numbers. For Santa Clara County, we went from 2 million to 1.8. Rough numbers, we went from 2.2 million to 1.9 million. That's $300,000. That's a 15% price reduction. And Alameda County has done the least at somewhere close to 1.4 to some number just under 1.3. So Alameda County has done the least amount of price adjustments. This is on log paper, which I prefer. This is on regular paper that some consumers may prefer. Here's the estimated payments that are in the same order as the prices. This graph is up here mostly to show that we only had 2,083 transactions. That's the second lowest. The only year that had fewer transactions is last year at 1,800. So we were 10% more than last year. You can see that you're only 78% of the 10-year median. That's pretty significant, in my opinion, to be that low. So we're basically the second lowest year out of the last 9. We're also the second lowest year out of the last 25. Here you're showing the actual raw counts for Silicon Valley, Santa Clara County, San Mateo County, or Alameda County individually. Whatever you're interested in, you can see the number of new listings is going down. The active inventory is increasing. The number of offers is actually increasing. The DUI, the ratio between the two, is basically unchanged in Santa Clara County, but it's down in San Mateo County and Alameda County, which is an accelerating marketplace. It's taking less time to sell the properties. You can see the time on the marketplace, all the stuff about overbidding. You can see what the median is, what the average is, which we don't even talk about this. The median is lower than the average, which, normally the average is typically bigger when you have a number that goes from some finite number, like in the case of overbidding, could all the way be down to zero. Very rare it's going to get there, but it could go all the way up to infinity. There's no cap on overbidding. In that situation, the average overbid is usually greater than the median overbid. So you can see the median overbid is 2.5%. The average overbid for Santa Clara County is 4.3. The frequency of overbidding is 66%, so 2/3 of the sellers. Appreciation is 87. So basically, these are the actual numbers for the different areas. I don't do this for the micro market areas. We've been talking about the Silicon Valley real estate market analyticals for August 17th. This is data through August 15th, gathered on August the 16th, presented on the 17th. Then we're going to finish up with the Greater Bay Area. 13 counties is measured by 3 regions. If you want to get to the archives, you can type in the blue YouTube URL, or you can type in the shorter green root URL. To join the presentation Saturday morning live at 9 a.m., you just type in the green root URL plus 2024, and if it asks for the passcode, it's there. It should not, but occasionally it does. If you want the handouts, if you want a 66-page PDF of the key slides that we just went over, just put in the green root URL, H for handout 2024-08-17 for the year, month, date code, and the same for any specific episode, the year, month, date code, but no H for handout. I'm Richard Calhoun, Creekside Realty, working with buyers or sellers here in Silicon Valley. Please consider liking and subscribing. I'm not seeing any unmuted mics, so I will assume there are no questions. If there are, break in. Moving on to the Greater Bay Area, I covered in 5 regions. The first region is Silicon Valley that we've talked about in depth. The second one is what I call the cities, which is San Francisco and Marin. Then the North Bay, which is Sonoma, Napa, Solano, and Contra Costa. Central Valley being San Joaquin and Sacramento, and the Central Coast being Santa Cruz and Monterey. Here's the inventory. You can see inventory in all 5 regions is down from where it typically is. The region that's down the most probably is Central Valley, and that's just guessing looking at the percentages. You can see that Central Valley, North Bay, and Silicon Valley are all very close together. Coming back in time, normally Santa Clara has less inventory. So basically, I think there's 2 tails here. You have the tail of the North Bay and Central Valley that have limited inventory compared to normal. Silicon Valley, Central Coast, and the cities all have less inventory than they normally do, but not as much less inventory as the first 2 regions, being the North Bay and the Central Valley. They're the hardest hit, with Central Valley being the hardest hit, because I say that because the 2 are very similar up here, and now the Central Valley is below where the North Bay is. Here's the number of offers accepted. So even though Silicon Valley was 3rd in inventory, it has the most offers that are being accepted. It's sort of interesting that Silicon Valley was doing the steep decrease, and the other areas were sort of basically flat, but then the other 2 areas turned around first, and now Silicon Valley may have turned around this last week and gone up. So we had a period of time where it looked like Silicon Valley was going down while 2 of the big regions were going up. Now you have 3 out of the 5 regions going up. You also have the cities going up, and the Central Coast has been just meandering upwards. Here, what you're looking at is days on unsold inventory. Santa Cruz, Monterey, being the Central Coast, is the slowest at 80 days. Silicon Valley is the fastest at 40. Basically, the other 3 regions are pretty close together, between 45 and 55 days to sell their entire inventories. Silicon Valley fastest, Santa Cruz, Monterey the slowest, the other 3 pretty crunched together. Time on the market, Silicon Valley, this is the time on the market for 3/4 of the sellers to sell. So slightly different benchmark with similar results. Silicon Valley is the fastest. Here's Santa Cruz, Monterey, the Central Coast area, is actually in 3rd place. although the three regions are fairly close together, and the Central Valley is clearly in a strong second position. Price reductions, this is how common are price reductions. So they're the most common in the Central Coast. Then you have the North Bay and the cities very close together. Central Valley and Silicon Valley and Central Valley are doing the best with the least amount of price reductions. And to give you an idea, even in the Central Coast, which is the biggest, they're only taking a 2.5% price reduction on average. This is the frequency of seller price reductions, the least frequent, the least uncommon, the least common occurrences of price reductions is Silicon Valley, and that's somewhere around 16% of the sellers are doing price reductions. The highest price reductions are in North Bay and Central Valley with 32%. So basically a double of the Silicon Valley. Central Coast is in third at 28%, and the cities is at 20%. This is the frequency of overbidding. This is what the buyers do. Silicon Valley has the highest overbidding at basically 5.5%, followed by the cities at something like 5%. And then you come all the way down to basically 100% for both the North Bay and the Central Valley. And the Central Coast is actually under by 0.5%. So the sellers on average are taking a 0.5% price reduction off their ask price to get their offer accepted. Here's the frequency of overbidding. Most common in Central Valley at somewhere around 68%, followed by the cities at 52%, so a fairly significant drop. And then you start coming in pretty close together. North Bay at 45%, Central Valley at 43%, and Central Coast at 38%. Here's the long-term appreciation. The big takeaway is the cities has had the lowest appreciation, currently at only 30, well, not even at 30%. Basically 27% appreciation since 2015. Then you have the North Bay at 68%, and then you come in with Central Coast at 78%, Silicon Valley at 81%, and the highest rate of appreciation, and I believe this is related to the pandemic and the commute, is the Central Valley at 92% appreciation since the last 9 months of 2015. Here's the sold price. Of course, Central Valley is the most affordable, followed by North Bay. Then you have Central Coast. Notice that Silicon Valley is now actually significantly more expensive than the cities area. You can see that they were very close together all through the first part of this year. And historically, the cities has been more expensive than Silicon Valley. We currently have a reversal happening right now with the prices in the cities dropping more rapidly than they dropped in Silicon Valley. Here's the estimated payments that are going to be in the same order. You have the San Mateo County or Silicon Valley up here at the highest monthly payments by just a small amount. Then you have the cities, Central Coast, North Bay, and Central Valley is the most affordable on a monthly basis. And that assumes an 80% mortgage on a 30-year fixed at the federal national rate for conforming loans. Here's the numbers for the 5 regions. I have each county. I also have Silicon Valley. I have also the Bay Area, and I include the Bay Area even though I believe it's a garbage number, and that's simply because the media quotes about it so much. You know, when you look at the variation of the 9 individual counties that make up the 9 Bay Areas, they range so dramatically, you know, frequency of overbidding anywhere from a low of 28% to a high of 70%. So you got a range of almost 50%. And to turn around and say that the overbidding is at 57%, you know, is meaningless. You go all the way down to 28%. So you're half of that in some areas, and you're 50% higher than the other areas. Or to say that the median price is 1.2 million or 1.3 million almost, when the median price for each area ranges from 600,000 all the way to 1.9 million, is really, it's a number, it's an accurate number, but I don't think it really tells you anything. In fact, I'm not even sure the county level tells you, which is why I broke in Silicon Valley, my focus, into the 20 micro market areas. We've been talking about the Silicon Valley real estate market analytics. We've already gone over how to participate on this. That's earlier in the presentation. I'm Richard Calhoun, working with buyers or sellers here in Silicon Valley. Please consider subscribing or liking. I'm not seeing any unmuted mics, so have a great week. Take care. See you next week. Bye for now.